Fuel prices have been skyrocketing in India, causing massive protests across the country. The rise in fuel prices has a lot to do with the current state of the economy as well as some external factors. The main cause is the depleting rupee against the US dollar, which dropped to a record low at more than 74 rupees this week. The excise duty on petrol and diesel levied on the sale of the fuel is also in question. There is still a significant difference between the price of diesel and that of petrol due to differential rates of the excise tax imposed. It is further highlighted by differences in the VAT rates imposed on diesel and petrol by individual states. The centre currently levies an excise duty of Rs 19.48 per litre on petrol and Rs 15.33 per litre on diesel and VAT of 27% on petrol and 17.24% on diesel. Petroleum prices are determined by the cost of crude oil in global markets. India is one of the biggest importers of crude oil from Iran. The current US sanctions against the country have affected its oil production, thereby increasing the cost of crude oil. Being the third largest importer of crude oil, India imports about 1,575 million barrels of crude oil from Iran on an annualized basis. About 20 years ago, in September 1998, one would have paid just Rs 23.94 for a litre of petrol in Delhi. Think about now. It's an increase of more than 300% in 20 years. That comes to about an average increase of 12% per year. In 2008, when the oil prices were rising, it had a major impact on India's economy, causing the rupee to rise, and fuel-dependent industries like the airlines saw a major fall. The crude oil prices hit a high of $107 per barrel in 2013-14. In 2012, crude oil price hit a record high of $127.27 per barrel, but the petrol prices stood approximately at Rs 70 per litre. Fuel prices in India are the highest compared to Venezuela, Iran, Nepal, Sri Lanka or Pakistan. Venezuela pays about Rs 0.71 for 1 litre of petrol, while Pakistan pays Rs 54.73 per litre, Sri Lanka pays Rs 53.26 and Nepal Rs 63.11. In the near term, the extent of decline in Iranian oil exports after the US sanctions kick in from November 4 will be watched keenly. If current market conditions continue, once the sanctions on Iran are implemented, oil prices are likely to go up further.
On the economy generally, the weakening of the rupee means that the cost of imports, of all types of imports, not just oil imports, is going up because the rupee has weakened. Quite apart from the fact that the oil import bill has gone up, which is what is showing up in the current account deficit rising to dangerously high levels. So, the unfortunate problem is that we have not succeeded in the last several years to increase export revenues. Our export revenues actually lower today than they used to be about 5 years ago. This is a very serious situation. Part of the reason for that is the appreciation of the rupee, meaning the real effective exchange rate of the rupee actually appreciated by about 20% in the last 4 years, which is not good, which is only one reason. There are many others for our exports not rising, while at the same time, as I am saying, our import bill is rising.
Under the current scenario of the falling rupee, the Indian government is also afraid that even if it cuts the excise duty by a few rupees, the respite may be swiftly reversed if the rupee slips any further. Higher oil prices are a threat to inflation as well. Corporate India will suffer incrementally as rising oil prices together with a declining rupee will increase cost pressures for most domestic market producers. In particular, the margins of paint companies and lubricant makers will be under threat. Airlines will get squeezed further at a time when they are unable to raise airfares enough, and rupee depreciation will increase their dollar-denominated costs. Shares of state-run oil producers such as ONGC and Oil India Limited stocks have underperformed in the current financial year despite high oil prices. India has a lot to lose with Brent crude, the Asian benchmark, surging to a near 4-year high in October at $85.84 per barrel. The International Energy Agency has said that the recent Brent crude prices could be tested by the prospects of oil exports from Venezuela and Iran declining. The price rise will adversely impact the world's seventh largest economy, as it will widen its fiscal and current account deficits, affecting consumption and investments. The high fuel prices are causing severe hardships to the common man and will have a cascading impact on prices across goods and services in the not-so-distant future.
Generally, any price rise will have an impact on inflation. Since especially the fuel prices, they are used not merely in our personal transport, they are also used in general transport, in the road, in the railways, in the aviation sector. So the transportation costs are going to rise. That means the cost of goods and services will also rise. So in that way, indirectly, it will add to the inflation. So that is, one should be worried about the continuous rise in fuel prices.
So what can India do in this situation? Iraq and Saudi Arabia have traditionally been India's top oil source until Iran took the second spot in June this year. As one of the largest oil buyers, India will require to find new sources of crude at a higher cost, which is going to hurt. Washington may grant waivers for major importers of Iranian crude, but still expects them to ultimately comply with the sanctions. India will therefore be forced to turn to other producers to meet their energy needs. Washington has offered to replace the loss of supply with US oil, but those shipments will be more expensive than those from nearby Iran. India's overall oil imports from Iran in June declined by about 32% in August as refiners started weaning their plants off crude from Iran.
Normally, these fuels, especially petrol and diesel, are called price inelastic. That means they are not influenced by prices. The consumption will go on irrespective of the price. Therefore, we cannot try to curb or ration consumption. And secondly, we have to import at any cost. You can't, bring the economy to a halt, because this is it supplies the energy. So you have to willy-nilly, even if it is high cost, you have to import and maintain the economy. So I don't think you have any choice here, except to play about in, say, for example, if Iran is the problem, you have a rupee account, try to circumvent what the US sanctions, and so think of such devices. Otherwise, there is no option, you have to import.
Other likely options to replace Iran's oil include Saudi Arabia and Iraq. As for the US, Energy Information Administration data reveal that US crude exports to India reached a record high of 413,000 barrels per day in June. But while the government keeps weighing its options, the economy and the value of the Indian currency will continue to be heavily dependent on the price of oil. Until the time, an alternative resource replaces fuel as the primary choice of consumption.